You're listening to the Financial Source Podcast, your daily dose of sentiment updates in the European and U.S. sessions and critical risk event previews so you stay up to date with what's moving the market right now. Each session is carefully crafted personally by the Financial Source analysts and voiced by our AI hosts who, as it turns out, sound a lot better than we do. Here's Rachel and Michael with this session's deep dive.
Welcome back to the deep dive. So the story today, it's really about global markets trying to navigate with, well, almost no visibility. We're right in the middle of this extreme uncertainty, and it's all stemming from the U.S. government shutdown and, this massive data blackout it's caused. Yeah, so our mission for this deep dive is pretty clear, and it's critical. We really need to analyze how global finance is actually reacting now that Washington's gone silent on the data front. I mean, the usual playbook, waiting for those big U.S. numbers like the September jobs report, that's completely out the window. So we're tracking this big shift. Focus is now on alternative signals, central bank talk, maybe some unusual policy stuff, and frankly, just geopolitical noise.
Exactly. And what jumps out immediately is that markets just hate uncertainty, hate an information vacuum. When your main source of economic truth, that's typically U.S. jobs and inflation data, just vanishes, investors don't just freeze up. No, they start reweighing everything else they can see.
So things that were maybe just background noise before are suddenly front and center.
Absolutely. They become screaming signals. And today, specifically, that means the ISM Services release and, whatever central bankers are saying around the globe, that stuff is carrying, maybe 5 times the weight it did just last week.
Okay, right. Let's unpack that force shift then. Because this shutdown, it's not just politics, is it? It's fundamentally changed how the global economy is even thinking about risk, like right now.
It really has. It's this forced reliance on leading indicators, softer surveys, qualitative stuff, completely replacing the hard data we normally wait for. It's like the whole hierarchy of information got flipped upside down overnight.
Which I imagine puts central bankers in a very awkward position.
Oh, an impossible position. They're supposed to be data dependent, right? That's the mantra. But now the key data is just missing. We actually saw Fed voter Austin Goolsbee talking about this directly. He basically confirmed the FOMC will just have to rely on whatever scraps of information are available during this shutdown.
Okay, but he also added a big note of caution, didn't he? Something about warning against front-loading rate cuts. What's the actual risk he's pointing to there?
Yeah, that was crucial. It's a huge policy risk. Front-loading means, making a major policy change like cutting rates really aggressively based on thin, maybe incomplete, maybe just anecdotal evidence. Think about it. If the Fed were to pivot hard based on, say, 1-week survey or just general political unease.
And then the real jobs numbers eventually come out, and they're strong.
Exactly. They'd lose massive credibility. They might have to slam the brakes and reverse course immediately. So Goolsbee is essentially signaling, look, we're being cautious. Yes, the lack of data is bad, but don't assume we've suddenly given up fighting inflation just because we can't see the road ahead perfectly clearly.
But hang on. The whole reason for this shutdown is political fighting. Does the market actually buy that the Fed can stay purely data dependent when the only data floating around is political noise and survey guesswork? Doesn't that kind of gridlock inevitably chip away at the Fed's perceived independence?
That is the absolute core tension right now. Yes, the market knows political chaos can easily bleed into economic sentiment, but the Fed is trying really hard to build a wall between monetary policy and all that fiscal drama.
And is it working? What are markets signaling?
Well, look at the dollar index. It's actually holding steady, kind of quiet inside yesterday's range. That suggests that, okay, while volatility is definitely up, traders are, for the moment, listening to Goolsbee's caution. They seem to be waiting for something more concrete, maybe that ISM data, rather than just betting the farm on a premature Fed pivot driven solely by Washington headlines. And if you connect this sort of U.S. holding pattern to the wider world, you see how policy stability elsewhere suddenly matters a lot more for currencies. When the U.S. lighthouse dims, other central bank signals get brighter, relatively speaking.
Right, like the Bank of Japan. They've been pretty consistently accommodative, trying to get growth going.
Precisely. We heard Governor Ueda just underscore, again, the need to keep that easy policy setting going, especially after that Tankin survey showed things are still challenging. Now, that clear message, that stability, It immediately helped dollar-yen firm up. It's now just hovering around its short-term moving averages.
So the lack of noise from the Fed basically allowed Ueda's fairly standard statement to become the main driver for that currency pair.
You got it. It allowed the pair to find some clear technical footing because the usual dominant force U.S. news was muted.
Okay, so zooming out. What about the other big currencies? Is this U.S. situation just causing inertia everywhere else?
It kind of feels like it. The euro, it's quiet, holding above 1.100. And that lack of movement is telling. When the main driver U.S. data is offline, local news or the absence of it, like the pretty empty euro area calendar, becomes a stronger anchor. It dampens local volatility.
Makes sense. Same story elsewhere.
Yeah, pretty much. Sterling's barely moved, around 1.3450. Everyone's just waiting for the final UK PMI readings and whatever the Bank of England governor might say. And down under, the Kiwi dollar is steady. Traders there seem to be looking past the immediate noise and just focusing on next week's RBNZ decision. The market's basically consolidating, choosing to wait for scheduled central bank events rather than reacting to, vague whispers out of Washington.
This brings up a really interesting point, though. When central banks are facing this kind of systemic data gap and all this political risk, how do they adapt? They can't just keep using the same old tools and models, can they?
No, they can't. And this leads to something quite fascinating, a real aha moment, actually, coming out of the Bank of Canada. Deputy Governor Nicholas Mendes recently talked about work they're doing to fundamentally refine how they measure core inflation.
Oh, really? More than just tweaking the numbers?
Much more. This isn't just a minor adjustment. They're apparently developing a sophisticated multivariate approach, a new model designed specifically to better isolate the really persistent, sticky price pressures, the underlying inflation trend, from all the temporary shocks and noise.
Wow. Okay, so they're basically trying to build like a more robust inflation signal that's less vulnerable to noisy data, building redundancy into their system.
That's exactly it. It's a reminder that while we're all obsessing over the missing headline numbers behind the scenes, central banks are actively trying to rebuild their analytical plumbing. They're acknowledging that, hey, maybe this volatility and data disruption isn't a blip. Maybe it's the new normal, and they need stronger foundations to deal with it.
That insight into central banks adapting their internal tools is a great segue to another foundational market, commodities. How are they trading with this weird mix of cautious central banks and, well, all the geopolitical risk? Crude seemed a bit firmer after that slide on Thursday.
Yeah, crude's interesting. The immediate driver there isn't really Washington or Ottawa policy right now. It's action happening elsewhere. All eyes are firmly fixed on this weekend's OPEC Plus meeting. The absolute key question is how quickly they decide to unwind those remaining production curbs.
That decision basically sets the near-term path for oil, regardless of U.S. data.
Pretty much. It's the dominant factor for oil right now.
And the sources we have are giving some pretty specific numbers they might be considering for production increases.
They are. Reports suggest the core producers are seriously thinking about bringing those withheld barrels back online faster than previously expected. We're hearing talk, speculation really, about a potential hike in November. The range being floated is somewhere between, say, 274,000 and maybe 411,000 barrels per day.
That's quite a range. What does the difference imply?
Well, it's critical. A move towards the higher end, near 411K, would suggest OPEC Plus is pretty confident about global demand holding up, and maybe they want to start reclaiming market share. That could actually put a bit of a lid on prices. But a hike closer to the lower end, 274K, keeps things tighter.
And wasn't there other data suggesting output is already rising?
Yes, exactly. A separate survey estimated that OPEC's output actually rose by about 330,000 barrels per day in September already. So even before any official decision this weekend, more crude is already hitting the market. Now that definitely puts pressure on the group to kind of formalize a plan.
Okay, so oil is watching OPEC Plus forward. What about metals? How do they react to the U.S. data void?
Metals reacted, well, pretty predictably. Gold, for instance, had run up a bit in anticipation of potentially weak U.S. payrolls data. But when the data didn't actually arrive...
the rally just stalled. No hard confirmation, no more fuel.
Exactly. The rally ran out of steam without that confirmation of a weaker labor market. And copper. It's just treading water, hovering around the $10,500 per ton mark. But that's largely technical. Liquidity is really thin, specifically because mainland China, a huge copper consumer, is still shut for the Golden Week holiday.
Ah, right. So it's just waiting for the big buyers to come back online.
Precisely. It's a classic example of markets taking the path of least resistance. In this case, that means just waiting until the world's largest consumer is back at their desks.
This whole situation, this shift in focus, it really highlights how direct policy actions can become massive market drivers when the usual data is missing. Like on the trade front, Washington isn't totally silent, right? They're apparently weighing these direct taxpayer rebates.
Yeah, this is quite something. Rebates between $1,000 and $2,000 per taxpayer. And the really novel part is they're talking about funding these directly from tariff revenue.
Which bypasses the need for Congress to approve new spending during the shutdown.
Exactly. It's a potentially significant policy injection using existing mechanisms. And alongside that, officials are also apparently preparing cash support for U.S. farmers using existing USDA resources. Plus, there's talk of even more tariff-linked aid being considered.
So this ties right back to our main theme, doesn't it? The data vacuum is being filled, or at least compounded, by these new, very visible, proactive government actions designed to pump liquidity straight into the economy.
Absolutely. And that kind of direct liquidity injection can move markets just as much as a surprising jobs report, sometimes more because it's so politically charged.
And that kind of activity, that direct intervention, it feeds straight into the risk sentiment bucket, especially when you layer on the geopolitical headlines that are suddenly getting more attention. Let's talk Ukraine and Russia for a second. The U.S. is reportedly planning to give Ukraine intelligence for strikes deep inside Russia and asking NATO allies to help.
Right. That's a clear step up in operational support, a definite escalation. But interestingly, separate reports suggest the actual plan to send long-range Tomahawk missiles might be hitting snags due to, well, low existing stockpiles.
Which, for the market, highlights things like military supply chain risks. Maybe readiness issues.
For sure. It affects defense stocks, obviously, but also feeds into broader global security worries and sentiment.
And we also had that brief reminder of European security issues with Munich airport closing overnight because of drone sightings. It reopened, but still.
Yeah, exactly. These small incidents, while maybe minor on their own, collectively keep that sort of geopolitical risk premium elevated in certain areas. They remind investors that local risks haven't just disappeared because Washington's tied up in knots.
Okay, and while we're on geopolitics, we should probably touch on the latest remarks from Moscow from President Putin. What were the key takeaways there for markets?
Right, so synthesizing his points. He criticized Sweden and Finland joining NATO. That's pretty standard rhetoric. But importantly, he also stated clearly that Russia does not intend to attack NATO. That's a slightly de-escalatory signal. Helps calm the extreme tail risk fears a tiny bit.
But he also talked energy and resources, which is crucial for commodities, right?
Absolutely crucial. He argued that global energy demand will simply continue to need Russian supply. And he made a point of highlighting Russia's ongoing uranium exports to the United States.
Reinforcing Russia's systemic importance despite sanctions.
That's the key message. He's reminding everyone, look, despite everything, Russia is still a critical supplier of essential resources to the West. These markets remain very sensitive to any policy levers he might choose to pull. And he finished with a warning that any further escalation, especially at sea, would significantly raise risks, which directly impacts things like maritime insurance costs and global shipping. So, okay, boiling all this down, what does it mean for you, the listener, trying to make sense of this mess?
With the normal calendar basically empty because of the shutdown, the things driving markets today are really specific, maybe non-traditional inputs. You've got that ISM Services reading that's high impact now. You've got these very pointed central bank comments like from Goolsbee or Ueda, and then any updates from Washington on those liquidity or aid plans. Those three things are likely steering FX and precious metals today.
And for oil?
Oil is all about the weekend OPEC Plus meeting. Their decision on production cuts will set the immediate direction for crude.
So the actionable knowledge, it's not buried in economic data spreadsheets right now. It's in parsing press conferences, understanding these subtle policy refinements like the Bank of Canada's inflation work and tracking geopolitical chess moves. It really demands a different way of thinking. Which leads us to the final thought for you to consider. Given that the U.S. is basically driving global markets through lack of data right now, forcing reliance on political headlines and these softer surveys, how does that fundamentally change how global investors and even policymakers like those Canadian central bankers building new models have to assess risk? What happens to the reliability, the very nature of risk assessment when the main beacon goes dark and you're navigating by these sometimes flickering alternative signals? That's a really complex question to chew on until our next deep dive.
Thanks for listening to the Financial Source podcast. If this podcast helped you at all today, would you consider leaving us a review to help spread the word? Each month, we also give away different resources and indicators just to podcast listeners. So write into Financial Source at support@financialsource.co to claim your free gift today. Talk to you all in the next episode.